All right, let's dive right into a really fascinating story about a company that's right at the heart of American healthcare. It's a wild case of massive value destruction, a totally panicked market, and, well, a crucial piece of evidence that seems to be hiding in plain sight.
So here's the big question, right? How does a company that's responsible for the health insurance of millions of Americans, a company whose revenue is literally backed by the government, suddenly lose half its value? It just doesn't seem to make sense. So in this explainer, we're going to investigate the dramatic fall of Centene Corporation and try to uncover the hidden story the market seems to be missing.
Okay, first things first, let's set the scene. Centene isn't some flashy tech company. You could call it systemically important. I mean, it's a core piece of our country's healthcare infrastructure, providing government-backed health insurance to over 13 million people, mostly through Medicaid.
But then, in 2025, the market absolutely panicked. The stock went into a total free fall, just erasing billions and billions in value. And look, this wasn't some slow decline. It was a sudden, sharp collapse that made everybody ask, is this company fundamentally broken? And that, right there, is the mystery we're digging into. So what happened? Well, according to the analysis we're looking at, it wasn't just one single thing. No, it was a perfect storm of negative news, bad headlines, and scary events that all hit the company at the exact same time. It created this picture of a company in really deep structural trouble.
And what's really interesting here is how all these different pressures just fed on each other. You've got costs going up, a huge unexpected loss from the ACA, the company pulls its own financial guidance, and all this is happening with political fears in the background. It all combined to create one single, terrifying story for investors, that the whole business model was failing. A couple of these hits were just particularly shocking. First, this surprise $1.8 billion loss from the Affordable Care Act marketplace. Basically, the company found out its members were a lot sicker than they thought, and a key government payment they were counting on just, poof, vanished.
And that was followed by a headline that was everywhere, a massive $6.7 billion accounting charge. Now, when you see a number that big, you think it's a catastrophe, a complete operational failure. But was it?
So here's the crucial point. This wasn't a real loss. No cash actually left the company. It was what they call a non-cash accounting adjustment. You see, there's this rule that says if your stock price falls enough, you might have to write down the value of intangible stuff on your books called goodwill. So in a weird way, the falling stock price itself forced the company to book this huge, scary-looking loss, which of course scared investors even more and made the stock fall further.
You know, with all that bad news, it's really no surprise the market priced Centene for complete failure. But this analysis flips the script and asks a totally different question. What if we just strip away the panic and all that accounting noise? What is this company actually worth fundamentally?
And wow, this slide just lays out the disconnect perfectly. The market is saying the entire company, the whole shebang, is worth about $16.7 billion. But a really conservative analysis shows that just its core Medicaid business, plus the bare minimum cash it needs to operate, is worth at least $25.5 billion. The market is pricing this thing for less than it would cost to just rebuild it from scratch.
To put that another way, check out this chart on the company's price-to-book ratio. Right now, you can buy $1 of Centene's actual assets for just 66 cents. That is less than half of its own historical average, and it's just a tiny fraction of what its competitors are trading for. Okay, let's move on to what this analysis says is the single most important piece of evidence in this whole case. And it's not hiding in some earnings report or a press release. It's actually buried in federal law, and it acts like a powerful safety net for the entire business.
The whole investment idea here really hinges on this one concept: actuarially sound rates. Now, that might sound like a bunch of industry jargon, but it's not. It is a specific legal standard written directly into federal regulations that controls how Centene gets paid.
And this isn't just a suggestion or a guideline. It is a legal mandate. It means that by law, states are forbidden from paying Centene rates that are so low they would drive the company out of business over time. So if Centene's medical costs shoot up, the states are legally required to eventually adjust their payments upward to cover those real costs. It's the law.
So why does a protection like this even exist? Well, it's pretty simple. States have basically outsourced the incredibly complicated, messy job of managing Medicaid. They just can't replicate the networks, the technology, and the expertise that Centene has built up over decades. So letting this critical piece of healthcare infrastructure fail, it's just not a political or a financial option.
Okay, so if the business is protected by federal law, the big question isn't if this value gap closes, but when. And the answer, according to this analysis, lies in a totally predictable, documented timeline that's basically built right into the government's own calendar.
And what's critical here is that this isn't just Centene's hopeful thinking. Its biggest competitors have publicly confirmed the exact same industry-wide cycle. I mean, look at this. The CFO of their rival, Elevance Health, is pointing to 2026 as the bottom, with a clear recovery coming right after. They are all seeing the same predictable path forward. And this slide just lays out the roadmap to recovery so clearly. The cost spike that started this whole panic, it's a known event. The rate resets that will fix the problem, they happen on a fixed government calendar, usually July 1st. And the recovery window, well, the entire industry is already projecting it. It's almost like a mechanical, predictable cycle.
So what's the bottom line here? It seems like there's this massive disconnect. You have the market totally panicking over what look like short-term cyclical problems, while at the same time completely overlooking the long-term, legally guaranteed stability of the entire business model.
And that really leaves us with a final question to chew on. When a company's fundamental value is basically backed by federal law, is the real risk in the business itself, or is the risk in overlooking the facts during a storm of negative headlines and market panic? This analysis suggests the most valuable asset might just be the one hiding in plain sight, written right into the code of federal regulations.